welcome to a trading video. My nickname with my trading group is Susie MACD. And I'd like to share with you something that I've been sharing with some people through a paid service and putting it out here on YouTube. I think that it's easier to access it, it's easier for me to maintain it, and I'm going to try to keep these training videos pretty short, but it'll give you an idea of a simpler way to trade utilizing the MACD2 line and indicator and a couple of moving averages. So without further ado, let me start the way I start every week's workshop off, and that is with a risk disclaimer. And what I really want everyone to understand is most platforms have paper accounts. Anyone who is trying to take money from this market prior to being able to build up a paper account, it's really, really a high risk game. I always recommend to my following that you use a paper account to debug your strategy, to get your confidence up about what you're really intending to do repeatedly. What can you repeat? And then to simulate in reality. In other words, you don't just throw 10 lots on in paper, or 100 lots, or 50 lots, or I think this is going to move today, so let me just double my risk. The reason being, when someone like Captain Sully landed that plane on the Hudson River, he didn't do that because he was a hot shot in the training simulator. He did that because he had simulated in as realistic an environment as possible over and over and over how to get a plane down under the most adverse circumstances imaginable. You can't make this up, and you can't fly by the seat of your pants. So the first thing is to understand that the three things you control, number one is your risk. You should never trade with money that you have to have. If you can't afford to lose money, then you better be trading in paper. Here we go. I always start out with this lecture. So also, everything we're going to show you is simulated. In other words, it's hypothetical because we can't predict that you're going to get exactly the same identical everything in the future. But it's for educational purposes. And these patterns that we're going to show and this methodology of trading repeats itself over and over on all time frames. Okay? This little picture of this baby is exactly what you're going to look like when you find out that you have lost money that you couldn't afford to lose, and nobody wants to feel like this. All right, so without further ado, let me shut this down, and let's go out and let's take a look at how clean this trading methodology looks on a chart. Okay, what you're going to see here is you're going to see Tesla as it bottomed out end of last year into about 2 months ago. And this is what it looked like as it took the turn. This was the low of the MACD2 line, all cleaned up. I'm going to show you how to set your charts up. I'm going to walk you through this. But this first video is a risk disclaimer, and it's this overview of how clean and simple this can be. So as bottoming structure is setting in, I want you to notice that as price hits this line or goes below this line repeatedly, I want you to watch what's happening down here, because this is where we anchored that yellow line above, was right here on the low of the MACD. I want you to watch what's happening to the MACD. Do you see the angle of ascent versus the angle of descent happening here? And massive pullback below the yellow line here, price line. Okay? This is a form of divergence. It is the divergence between where the MACD, yes, a lagging indicator, yes, I understand that you've never learned to use it this way. It's the strangest thing on the planet to see it sitting here in isolation with no zero line and no histogram. But I want you to see the predictability of this push-up of the MACD. Eventually, it moved price. All right, now you can say, well, that's putting the cart before the horse. It's a lagging indicator. Well, what we're doing is we're using it as a predictor. We are using it to identify and clarify where it's saying price should be in a horizontal and vertical read much lower up here, pulling back, pulling back, pulling back lower and lower. The horizontal read and the vertical read of the MACD is saying that price probably belonged somewhere up here. Okay? I'm just superimposing this line up here. Now, I'm using Thinkorswim. This is a paper account. I just like the charts and I like the trading package. I trade this way with stocks, futures, and options. I swing trade and day trade. I do not do this with Forex, and I do not do this as a leg up around earnings. In other words, if I were to throw earnings on here, if I were to throw corporate actions on to see where earnings are, you would notice that this entry in through here did not coincide exactly with this earnings pullback. The day after earnings opened gap down, lifted back up. So if you were thinking, oh, well, I'm just going to apply this in an earnings world, what you would find is it doesn't always work. In fact, its rate of success is very slim when applied specifically to earnings. Pretty easy to trade prior to earnings and to pick up the movement after earnings, but it's not to be utilized over earnings. Okay, this does not help you with earnings. In fact, if anything, it gets you in a lot of trouble. So this is what we're going to look at. This is the trading methodology. As Tesla was turning, trying to take this turn, trying to reverse up, this was what we were watching. Okay, simplified trade. MACD kept saying higher, higher, higher. Come on, price, come on, price. And finally, price said, okay, all right, false start, okay, for real. And can you tell the difference? No, but the way we enter protects you a little bit from some of these false starts. All right, we'll get into that in the training videos. Right now, this is going to be the end of training video number 1. It is an overview. This is what we're going to get your charts to look like. If you have Thinkorswim, I'm going to show you how to do all these cute little drop-down boxes. If you don't already know, we're going to get you so that your charts are cleaned up. Now, if you don't have Thinkorswim, do you have to have Thinkorswim? Absolutely not. All chart packages have, these days, paper accounts, and they all have transferable functionality. So they might not be able to be made identical to this, but they can be close enough. All right? You'll notice I have superimposed my volume behind price just as a skyline, just so I can see high volume nodes. I can see where volume is increasing longer term, pulling back down into lower volume areas without it screaming at me in bright colors. I do not like to be distracted. Everything here is going to be color coded. We're going to color code the faster line on the MACD, green or aqua blue, and the slower line, red. And isn't it funny that they line up with our moving averages? The faster one, which is the 8 EMA, is going to match the aqua, green-blue. And you can use any color combination you want if you have a color blindness issue. And then the slower of the two moving averages, the 21 EMA, exponential moving averages, meaning the nearer candles or the nearer pricing has more weight. All right? So the 8 and the 21 EMAs color-coded to the fast and the slow lines of the default settings for the MACD2 line. 0 line removed. All right, we'll show you how to do all that. What it is by color coding everything, you don't have to think, is it the 8 above the 21, which is the green line, which is the red line? Down here, the defaults are blue and yellow. Which is the blue line, which is the yellow? I don't remember. And this way, there's no doubt. If this blue line is above the red line, shortly thereafter, or at the same time, the blue line here should be above the red line. Make sense? I hope it does. As it's rolling over, as the blue line here gets below the red line, shortly thereafter, there should be a cross of the 8 and the 21, and the blue line should come below the red line. All right? So we're using this as the early warning of what might happen, and we're using the 8 and the 21 as confirmation. The intention of this trading methodology is not to get this bottom, not to get in on this bottom. The intention here is to catch the middle part, the meat of these big swing moves when you use it as a swing trading vehicle. All right? With that, I hope this helps, and having this big open space on the right edge helps your eye see reality. Very hard to read these lines and these candles and the angles that they are portraying when you're butted up against this right margin. Okay? I don't know how people read charts that way. So this is what your chart will look like. Please join me in video number 2, and we will show you how to get here. Thanks.